Okay, good morning, everyone. We appreciate you taking the time to join today's ATRAM market update. Before we begin, I'd like to remind everyone that you may ask questions throughout the discussion by clicking on the Q&A button on your screen. If you would like to ask a question anonymously, you may do so by choosing that option in the Q&A section as well. We'll get to them at the end of the discussion. Additionally, I'd like to let you know that this webinar will be recorded and that copies will be disseminated within the day, as well as posted on all our social media pages. Lastly, make sure to keep your eyes on the webinar as you will also be participating actively this morning. Let's kick things off with ATRAM's Chief Investment Officer, Mr. Philip Hagedorn, who will update us on the latest news and insights surrounding the market.
Thank you, Santi, and good morning to everybody. Thank you once again for joining us this Thursday. First of all, we want to wish and pray that all yourselves and your families are safe and are healthy. And we hope that, as the economy starts to open up, that you continue to err on caution and play the safe game. And if you don't need to move and you can stay home and achieve your objectives, then that might be the best thing to be doing as we open up. But we're also very happy that we seem to be moving in that direction. We want to thank you all for joining this webinar series, and we're hoping that they've been helpful in guiding you a little bit as far as what we're doing with regards to your investments and sharing some of our thoughts and ideas. Next week, we have a very special program, which we want to invite all of you to. Next week's webinar will be hosted by the head of our Equities team, Julian Tarabago, or June. And June has a special guest next week. Our guest will be TG Limcauco, the CFO of Ayala Corporation, one of the largest conglomerates in the country today and among the leading corporate citizens in the Philippines as well. So we really look forward to that webinar next week to get some insights on how Ayala Corp is managing their business as we continue to open up the economy and move towards more normalcy, we hope, in the next few months. I also want to take this opportunity to thank you all because very recently, ATRAM was awarded by Asian Investor the Philippines Asset Manager of the Year for this 2020 year award. I guess it's the performance of last year, but again, very proud of this award and want to thank you all for your support and your trust in us. And we will continue to endeavor to maintain that trust and deliver the performance and service that you all expect from ATRAM. So thank you very much. Without any further ado, I'd like to introduce our speaker for today, head of our fixed income, multi-awarded Best Fixed Income Dealer of the Year many times. And Miguel Liboro will share with you our views on fixed income and the opportunities that they present in this volatile market that we have with us today. So again, thank you all for joining us today. And Miguel, the floor is yours.
Thanks, Phil. And again, thank you to everyone for joining us. Before I kind of get into it, I guess the first thing I'll start with is an apology for my hair. This is the best I could do with it, kind of crafting it into thing that you see before you. But don't worry, I have a point. As shallow as that remark may seem, I think that it perfectly encapsulates how this whole COVID-19 pandemic has affected our lives when something as simple or mundane as a haircut is something that we have not been able to have access to over the last 2 months. And with that, I'd like to begin. First slide, please. So it's been a challenging year for risk markets. COVID-19 pandemic has affected life as we know it, and financial markets are a very clear example of that. Amid all this uncertainty, risk markets have fared quite poorly in general, while markets that are perceived to be safer and generally more stable have gained. A very good example of this can be seen in the chart that we have before us, comparing Philippine equities against Philippine fixed income. Equities, as we know, generally is the more volatile asset class, and fixed income the more stable one. And I think this chart, which shows just the 4-month year-to-date returns of those respective asset classes, shows which side the general investing public would rather be in amid all this uncertainty. And fixed income has quite clearly been able to benefit from this flight to quality or risk-off mentality that investors have, at least at the beginning, quite correctly had. Now, I guess one thing I want to highlight is looking at things from a year-to-date, short-term basis, like this chart, we may think, okay, that makes sense. Fixed income has massively outperformed equities because of the fear factor, because this is a black swan event that nobody was anticipating. It's a massive risk-off kind of an outlier event, and normally you wouldn't really make a lot of money or significant gains in fixed income. But is that really true? Or are many of us just under that impression for a variety of reasons, not the least of which is probably that equities is the sexier asset class overall and does tend to be more top of mind and receive more attention in our in public and in our daily lives. Next slide, please. So what I want to do is kind of take a step back and really reevaluate that last statement that I made, that fixed income, maybe there's not a lot of money to be, or decent money to be made there. And stripping out this whole COVID-19 black swan event, let's take a step back 5 years. Because I think for most investors, 5 years is what they would consider a reasonable amount of time to allow a strategy or investment to play out to some extent. Now, a lot has happened over the last 5 years, and I've listed some of the key movers for the financial markets on this slide. And as you can see, quite evidently, not just with COVID-19, but over the last 5 years, fixed income has massively outperformed equities in the local markets. And two things really spring to mind when I look at this slide. The first is that, broadly speaking, being an investor in fixed income has paid off far better than being invested in equities over the same period. So I think that this kind of directly addresses or debunks the myth that I just mentioned at the end of our first slide, that you can't really make money in fixed income, because this slide speaks to the contrary, and over a 5-year historical basis, no less. And the second thing is, as expected, fixed income has tended to protect the downside better in poor market conditions. This is kind of expected, a little obvious. It is the more stable asset class. What's more surprising is that for those less familiar with investing in fixed income, it's been able to produce decent gains as well, both in negative environments, as you would expect, but also in stronger market environments, which I've highlighted there. A lot has happened over the last 5 years, and I've taken the liberty of placing some notes on what some of the more significant market moving events were over that period. And fixed income has done quite well. Now, whether you're primarily a fixed income or an equity investor, I think what 2020 has shown is that it certainly pays to diversify. And don't put all your eggs in one basket, as the old saying goes. The chart in front of us shows that Philippine fixed income has had more good years than bad ones over the last 5 years. And I believe that the good performance that we've already seen over the last 5 months of 2020 and over the course of this pandemic so far is poised to continue. Now let's talk about why. Next slide, please. Inflation. Inflation is typically the first thing that you think about when you're looking to invest in fixed income. And all the major factors continue to point towards lower inflation for longer term. Global oil prices are still have rebounded off lows, actually moving into negative territory early in April, but are still far lower than where they were last year. Food prices generally have been kept in check, at least for the staples, and prices of discretionary goods, we do not expect to move significantly higher anytime soon. All of these kind of point towards the theme of lower inflation for longer, averaging around the 2% level, much in line with the 2.2% full year average that the BSP has projected for 2020. Now, if you were able to catch last month's webinar, you'll notice that very little has changed in our inflation outlook. Since then, headline inflation has actually dipped to 2.2% for April, in line with the BSP's estimate for the year. Now, our longer term view on inflation notwithstanding, which is that it will stay at around the 2% level, we do think that there is some scope for inflation to adjust higher in the short term. We've been under ECQ for the last 2 months. That will be beginning to lift in gradual phases over the next few days, actually, and by next week. And we do think that coming from such a low base and so little economic activity, that there is room for a little bit of a short-term spike up on the back of that. And given how low bond yields have run recently, such upticks, while they may be short-term in nature, could cause an adjustment in the current level of yields. Next slide, please. So we've actually discussed that inflation is likely to stay lower for longer. And I do have some views on how we feel that the BSP or Banco Central is going to be acting on a moving forward basis. But before that, I'd just like to kind of do a small survey and kind of engage the audience, get a pulse for whether or not you guys think that rates will continue to move lower from a policy standpoint. So it's a simple yes or no question. Do you think that the BSP will be cutting interest rates this May? Yes or no? Okay. So we've got like around 2/3 of the group pointing towards a yes. So yes, people do think that whether or not it happens in May, rates will continue to move lower on a longer term basis. And that's, as I mentioned earlier, that is very much in line with our views. Next slide, please. Now, how many basis points do we think the BSP will cut rates by? Do you think it's going to be a more gradual adjustment, 25, 50, or as much as 75? And keep in mind at this point in time, the policy rate is actually at 2.75%, around 125 basis points lower from the 4% that we began the year at. Okay, so again, around 70% of the room thinks that there will be an additional 25 basis point adjustment. Again, very much in line with our views, as you guys will soon see. Okay, next slide, please. So BSP has wrapped up easing measures. As you can see from the chart on the left, comparing BSP recent action to the Fed acted, I guess, much more aggressively, and they cut their own policy rates by 150 basis points just over the course of March. So there was some criticism at the time. If you'll recall, yields were at their high levels or year high levels in March after the market initially sold off. There was criticism that maybe the BSP wasn't doing enough, especially when being compared to how quickly the US Fed had acted. But since then, as mentioned, the BSP has cut by 125 basis points, not insignificant by any measurement. They have cut the reserve requirement rate by 2% since the start of the year, taking us down to 12%. And each 1% cut was projected to release an additional 100 billion worth of liquidity into the market. And they've already essentially telegraphed that they intend to do another 2% reserve cut before the end of the year, taking us to 10%. Now, we think that after those measures, the BSP is probably poised to pause on cutting the overnight rate for now. We do think that the balance of risks favor an additional 25 basis point cut, taking us down to 2.5% from 275, but possibly later on in the year. We don't discount the possibility that the BSP could cut deeper than that, but we think that it's not something to be taken as a given at this point in time, and something that will be very much data dependent. Investors are already lowering their forecasts and expectations for economic numbers such as GDP. And depending on how those numbers actually pan out relative to where the estimates are, I think will determine further action from the BSP. So our base case at this point in time is another 2% on the reserve, taking us to 10%, and another 25 basis points, taking us to 2.5 by the end of the year. Next slide, please. So what's the market done on the back of all this easing? Yields have run significantly lower, not just from the peaks seen in the latter part of March, evidenced by the gray yield curve there, but also from where we were at the end of last year, which you see in the orange yield curve there. And that's really a combination of many things. Inflation moving lower, global rates continue moving lower very significantly, staying lower and expected to stay lower, but also in large part to all the BSP easing that we just discussed. And in fact, what we think is that this further easing is already largely priced in at current levels, meaning, although it hasn't happened yet, in our view, current market levels reflect the expectation for these lower policy rates. And because of that, we feel that, quite simply, rates have maybe run down too quickly and too soon. And while we do think that rates will be lower for longer, yields will be lower for longer, we think that given where they are right now, they are susceptible to a correction in the short term, especially given the very significant move that we've seen over the last 2 months. Next slide, please. For those of you that were able to attend the last webinar, you'll know that this is a chart that I've been harping on. The long-term historical spread or difference between the 10-year peso government security and the 10-year US Treasury has been around 2%. That means that simplistically, people consider the Philippines 2% riskier than investing in the US. Now, in March, that spread or differential blew out to more than 4%. As you can see in the chart, it blew out to around 420 or 4.2%. So simplistically, this means that people thought that the Philippines was suddenly twice as risky as it usually was. And we weren't the only ones affected by the COVID-19 pandemic. That happened to everybody. And we weren't suddenly downgraded to non-investment grade. We're still investment grade. So based on that reasoning, we felt that those levels didn't make sense. And given the view that interest rates in the US were going to stay lower for longer, we felt that interest rates in the Philippines had to come down from those levels as well. You saw that happen last month already, when that spread of 420 actually compressed to around 340. And you've seen it compress further still from that 340 down to 260. And now it's much closer and much more in line with the historical average that we just discussed of 2% or 200 basis points. And all of that movement just over the course of the last month and a half to 2 months. And I think that this supports our argument that while we think rates will be lower for longer, maybe current levels are pricing in too much. And that's why, next slide, please. We felt it prudent to take some gains, take some risk off the table. The yield curve is now quite flat. Your 10-year bond is trading at around 3.15 to 3.2%. Your 1-year bond is trading at 2.9 to 3%. In our view, that doesn't present a very attractive risk-reward proposition because you take far more risk investing in the 10-year, but for just marginal difference in yield. And that's why we think there might be a short-term adjustment higher in longer dated bonds. Because as we said, we do expect policy rates to remain low. And because of that, short-term bonds, so bonds on the 1-year to 3-year, will likely stay at current levels or possibly adjust even lower. Whereas long-term yields are more susceptible to an adjustment higher in the short term. And if that adjustment should play out and the levels that they move to suddenly make more sense for us to position the portfolio on, if we're being paid more to take that level of risk again, then at that point, we will reevaluate taking those risks and buying back into longer dated debt. As you can see here, from a positioning standpoint, we've completely de-risked the portfolio at current levels and are now looking at things on a more event-driven, short-term basis. Our longer view for lower rates is still intact, but given the factors that I mentioned, we do think that there is a potential for yields to move higher in the short term and to allow us better opportunities to manage the portfolio and re-enter at those better levels. Next slide, please. So let's put some numbers on this. Investors in Philippine bonds will continue to benefit. For those invested in our fixed income strategies and specifically in the ATRAM Total Return Peso Bond Fund, as of the end of April, your investment has generated a return of 608%. As of yesterday, that 608 is already 6.5%. And this is against a backdrop of largely negative returns across broadly global asset classes. Now, short-term risks, which we consider opportunities, notwithstanding, we remain positive on the outlook for Philippine fixed income. And given the environment and the volatility that we mentioned, we expect it to favor actively management strategies like our own. And if you'd like to look at the risk metrics a little bit more closely, you can see on the bottom left there that comparing it to both the Philippine Fixed Income Index, we've been able to generate superior returns. And just putting it there against equities as well. So at this point, we'd like to thank you again for your trust and your support in us. We're constantly looking for opportunities in the market to protect and grow our clients' investments. And at this point, I'd like to pause and be willing to take on any questions. Thank you again.
Okay, thank you all for your insights. What we're going to do now is open up the floor to a few questions from the audience. Again, you may ask questions throughout the discussion by clicking on the Q&A button on your screen. Please keep them coming. Miguel, what is your view on how unlimited QE, or quantitative easing, ends? And what are the repercussions on inflation, markets, and interest rates?
Okay. Very complex question. I'm going to have a drink of water first. Okay, so first, thank you for the question. I'll take it in two parts, I guess. For the benefit of those that are less familiar with quantitative easing, I'll do a bit of an explanatory answer first and then address the actual question. So quantitative easing, while coming in many forms, is essentially an attempt from the government to keep interest rates low in order to foster economic growth. It typically takes the place of, it typically takes the form of lowering interest rates so that you disincentivize investors or consumers from saving, and you make the cost of capital or borrowing lower so that companies are incentivized to expand or generate economic activity. Now, this is actually what we've been seeing ever since the global financial crisis more than 10 years ago. And now I'll take the second part of the question. How do we expect to exit this, and what impact do we think it will have? Well, actually, as recently or as early as 2016, the US Fed, which is, I guess, the leader in this kind of global easing movement, already set themselves up to try and exit it. And you know this from the fact that at the end of 2016 was actually when the US Fed started raising their interest rates. So the first move is really to stop the tap on easy money. Raise companies' borrowing costs by increasing that policy rate. And they were essentially on autopilot, raising rates from the end of 2016 all the way until 2018. The plan, I suppose, was to raise interest rates to a point where they felt it was in line with inflationary expectations, which were at the time expected to move up. And then at that point, start reducing bond buybacks. Clearly, 2019 and 2020 threw a monkey wrench into those plans. 2019, because of the US-China trade war escalation, it put the whole concept of global growth at risk. And when you don't have growth, you probably don't have inflation. And when you don't have inflation, you probably should not be raising interest rates. So that kind of caused the stall in this attempt to step out gradually from quantitative easing, or QE. And then you had COVID-19 happen, and it just completely reversed it. And now the US Federal Reserve's policy rate is at zero. It's lower than it was after the global financial crisis. So when do we think we're going to be coming out of QE? Not anytime soon. It took us over 10 years it took us 10 years essentially from 2008 to 8 years, 2008 to 2016, to even try to scale out of it. And that attempt has clearly not panned out. So when will we do it? When the market stabilizes enough that that central banks globally can quit supporting their economies to this degree and begin raising interest rates again. What will be the potential impact at that point in time? It will depend on the pace of the unwinding of QE. I mentioned the US as the clearest example, but they are probably not the ones worst off from a global standpoint. You have the Bank of Japan and you have the European Central Bank, which have already employed negative interest rates over the last few years. Now, let's just wrap our head around that concept for a second. Negative interest rates. You are literally paying the bank to hold on to your money for you. It feels like the old-time idea of a bank in the Wild West, where you had to do that because a bank was a person with a safe and like a shotgun, and you didn't want to hide it under your bed because there might be bandits coming. So until we kind of see growth recover, we see economies recover to the extent that central banks can begin gradually phasing out the stimulus, I don't think that we have any end to quantitative easing in immediate sight. And the extent that, or the impact that'll have in the economy will depend on that recovery, I think.
Miguel, can I ask a follow-up to that question? Do we think then that ultimately the consumer is the one that's going to be paying for this with very, very low savings rates moving forward? And that's why it's even more important that people think of how to safely invest these savings, because my guess is that interest rates on the savings account side is going to be zero or close to zero for a while.
Yeah, absolutely, Phil. I mean, as I mentioned in the first part of my answer, it is one of the goals of this type of policy to disincentivize saving. And if you persist in doing that, you will earn next to nothing, or at worst, in certain jurisdictions, negative. And to Phil's point, it does force you to really think about what to invest in. Now, if in the current climate, it's not a business, then a strategy. We offer several that I think can, depending on your risk appetite, could come together in a good portfolio mix to at least try and beat inflation, at least try to generate a superior return to leaving that money in cash. Because inflation here may be low, but it's not zero. And if you're making 25 basis points per annum on your savings account, or if even that, and inflation's averaging at 2%, you're still 1.75% in the hole. So yes, I completely agree with Phil's point that given that rates are expected to stay lower for longer, we as investors, we as consumers, need to think about where we invest in so that we make more than that, make more than zero.
Okay, thanks, Miguel. I have another one here. Do you see risk of deflation in the US economy? And if that's the case, what would the impact be on fixed income investments locally in the Philippines?
Okay. Do I see the risk of deflation in the US economy? Well, we don't model it in-house. I've seen some of the research. I think that it's not the base case at the moment, but it's certainly something that could happen. What would be the impact on the Philippine economy? I think the most direct impact would be first, going back to that whole concept of historical spreads we mentioned. Deflation in the US would imply lower US interest rates still. And the first point of impact we would see, I think, is based on that spread or that differential between where US interest rates are and Philippine interest rates are. Because if you assume all things held equal, it becomes do I earn comparably more by investing in Philippine yields? So if nothing has changed in your outlook for the Philippines, it's still the same broad level of risk investing in Philippine bonds. And you're getting, at this point in time, 0.6% on your 10-year US government bond and 3.2% on your Philippine 10-year. So that's 2.6%. If US 10-year bonds, treasuries, suddenly move from 0.6 back to 0.3, which is their all-time 150-year low, which we saw earlier this year, wouldn't you buy a Philippine 10-year bond at 3.2? So that would be the first point of impact, I think. From a relative standpoint, it would make our bonds even more attractive, and investors would kind of force our yields even lower. Now, from an actual economic, in-depth standpoint, I'm afraid that we'd have to get back to you on that after discussing with our economists on what they think. But from an immediate market impact, it only feeds the case, I feel, for lower for longer rates and our optimistic outlook on fixed income.
Okay, thanks, Miguel. Fixed income gains are attributable largely to recent period following rates cuts. What's the expectation? Okay, I'll repeat the beginning. Fixed income gains are attributable largely to recent period following rate cuts. What's the expectation in terms of future monetary action? And what's your view on long-term interest rates as compared to the current level?
Okay. Well, on the first part, we kind of addressed that in one of the earlier slides. We think that it's a 2% reserve cut from 12 to 10. We think that a 25 basis point cut on the overnight from 275 to 2.5, but with a caveat that potentially the BSP does have the room to cut deeper if data comes out prompting them to. Where do we think yields will be relative to current levels? Actually, if you pull it back to that slide we had earlier of the spread differential between the 10-year peso and US. Yeah. So actually that that line that I drew over there in 2016 is the 5-year low of the 10-year Philippine GS, 3.1%. Now, from the start of the year, since we started giving this webinar, actually, I've been harping on 3.1% as the technical level that we felt 10-year yields were going to eventually get to. So yes, I think that towards the end of the year, 3.1 was where we were targeting to go. It's May 14, and we're practically there. Now, given everything that we've discussed, we don't think that at 10 years should be breaking below 3% yet. We're certainly not pricing in any scenarios at this point in time that would warrant, from a fundamental standpoint, that movement. And given that, as I mentioned earlier, given where we are now, I think that you're going to see yields move up on the long end of the curve in the short term. And that's really just a combination of, as I mentioned, the valuation being where it is at this point in time, and the fact that the Treasury has been issuing short-dated debt over the last quarter in response to the lack of liquidity in the market early on. That's no longer the case. You have abundant liquidity from all these BSP cuts, from the other easing actions that they've supported the market with. At the lows of volume, which was happening in March when the market was selling off and we were just beginning our ECQ, you had average volume in the market trading as low as 5 billion. That's very low. Now you're back to 20 billion to 30 billion volumes, very much in line with how volumes behaved in 2019. So you have a treasury that does need to issue debt still, because although we're not counting on an acceleration of the build fiscal push because of everything that's been happening, we are expecting more targeted fiscal stimulus to affect the demographics and industries, and that needs to be funded. And I think the BTR has played it perfectly by issuing short-dated debt over the first quarter, not really spooking the market when the liquidity wasn't there, but it's there now. And the BSP support is there now. And we feel that the BTR will be issuing longer-dated debt. In 2 weeks, they will be announcing at the end of the month what their auction schedule will be for June. And we believe that it's going to be maybe on the 7-10 year, possibly longer. And given where rates are and how flat the yield curve is, as I mentioned, 10 year at 3.1 to 3.2, 1 year at 2.9 to 3%. We do think that even though there is a lot of demand in the market, there is a lot of liquidity in the market, that there will be an adjustment higher. And that's our short-term view, an adjustment higher, which is an opportunity to re-enter the positions we've just taken profit on. Longer term, as I said, lower rates for longer on the back of policy rates to kind of generally stay where they are or maybe go lower, inflation to average around 2%, and global rates to stay lower.
Okay, thanks, Miguel. Okay, I think we'll have this one more question. Should we purchase the Ayala Land fixed income security being issued now?
I'm going to take a page out of our equity protocol and say that we don't comment on specific issuances. That said, I'll say that Ayala Land is a company that we think is going to be around in 2 years. So I don't necessarily think the default risk is high, but I'm not going to tell you to buy it or not buy it. Invest in the fund.
Maybe, Miguel, we can invite all again to next week's webinar where we have TG Limcauco and we can ask him that question directly.
Yeah, that's a much better.
All right, thank you, Miguel. Santi, any final words?
Yeah, okay, I think we can leave it there for this call. Thanks, guys. Thanks to our audience as well for your questions. If you have any further questions or would like to learn more about ATRAM strategies, please get in touch with your relevant ATRAM relationship manager. Additionally, a recording of this webinar will be released to all of you as well as posted on all our social media platforms shortly. As we end this webinar, we'll be sending a short survey to get your valuable feedback to ensure we keep making these updates relevant and useful. We hope you can spend a couple of minutes to answer the survey. We appreciate you taking the time to join us, and on behalf of ATRAM, I would like to wish you all the best of luck. Please stay safe and have a great afternoon.